Hello, YouTube. Welcome back to the Wealth Catchers channel. Thank you guys for tapping in and checking in. So, today we're going to talk about timeless wealth principles. Some information I feel like no matter what time period we are in or where we're at, that stuff that you could always abide by, stuff you could follow, right? So, don't forget to like, comment, subscribe. Definitely go down there in the comment section, leave some tips in there about some principles you follow or some guiding principles that keep you grounded and some stuff that you're, religious to, things that you hold near and dear that you follow, right, during this investing journey. All of us have different principles we follow and different methods and the ways we attack things, right? So we all can learn from each other. And a disclaimer, this is not financial advice. It's just for educational purposes only. And with that being said, let's go into it. So, again, we'll go over some investing insights, some stuff that's going to help us build a foundation. And obviously, our goal is for wealth building. That's what we're here for. And timeless principles, right? Stuff that, again, you could know it, pass it on to your kids, your grandkids could still know it, right? So, it's about quality information. So, some core investing principles. And again, I do reiterate all the time that I do believe in concentration, but I feel like diversification is what helps you preserve it, right? Once you get to a certain amount of wealth. And also, I feel like diversification for a newer investor, a beginning investor, is very key to keep them from being discouraged, right? So, point of diversification is for spreading risk, right? And to help mitigate it across different sectors, different asset classes, and it helps you have a positive psychological effect on yourself, right? To at least see some wins piling up. And then on the other side of that, for people who are like me, concentrated investors, right? There's a quote from Warren Buffett who says, "Keep all your eggs in one basket, but watch that basket closely." So that's just to highlight if you are going to go the concentration route, right? Concentrated route, you have a handful of stocks or a handful of sectors that you only rock with, that you only invest in. That's fine too, but you just have to keep a closer eye on it, right? More keen eye on it. And that's when you got to tap into the discipline. You got to tap into, your rules, the things that you abide by, right? And don't let certain noise knock you off your square. You feel me? So, diversification is a strong principle to have, and it's a strong guiding principle to have throughout your whole investing journey. And then, like I said, to pair that with, I also believe concentration is as well. But when you're in both of those realms, do understand what you need to be inside both of those avenues, right? So we got the long-term investing mindset. You know, Charlie Munger, which is Warren Buffett's best friend and investing buddy for a long time. Rest in peace to him. The first rule of compounding is to never interrupt it unnecessarily, right? So that's us letting compound work, right? So that's just us letting our investments compound over time, letting those returns build on top of each other. And the point of never interrupting it unnecessarily is meaning where this money has a goal, has a purpose in this account to continue to grow. This isn't money for us to tap into because our car broke down. Billy needs something for school. My daughter needs some shoes for the dance recital. This isn't the money that you touch. This isn't the money that you tap into. Same thing with the 401k, same thing for the retirement accounts. I know stuff happen, things go bad. Trust me, I've been there before. I've been in situations where I've sold off the 401k, and to this day, I still look back at it and thinking what that could have been in today's age, right? In today's time. Stuff I sold off 10 years ago that I could have had now, right? And it's crazy because it's just simply lack of knowledge, lack of foresight, right? Because you're thinking about the short term relief you could get, but not understanding that could be a long term detriment to you and into your wealth building journey, right? So If you're not going to die, I strongly advise don't interrupt the compounding. Keep it going, right? We gotta be patient and we gotta be disciplined, right? Those are two major things that's gonna take you long and far in this game because this is something you're gonna have to do over decades. So let's tap into the mindset and behavior. We gotta go into our emotional discipline. No panic selling. No impulsive decisions. You having a bad day, you're going on some hard times. I'm gonna sell everything in the account. We're not doing that. And healthy investor habits, right? All these things we need to make sure we're locked in with. We're staying high and tight with it, right? So we're not letting the red days, the red months, red years make us sell everything in our portfolio, right? Throw away all the hard work we've done over the years and time and make a decision that's going to hurt us for the next 2, 3, 4 decades of our lives, right? Off of one day, 1 week, or 1 year, right? That one choice could hurt you for decades. It's crazy when you actually put it in that perspective. Sadly, with the impulse decisions, we're not going to do no crazy buys. We're not going to do no off the wall stuff. This is not for gambling. If you want to gamble, go to Vegas, go to casino, go to Prize Picks, DraftKings, whatever it is. Go ahead and take care of that. Somewhere else, do not do it in your freedom account. Don't do it in your retirement account. Again, this is all about freeing yourself financially for the future, right? It's what you're doing now. So you don't have to be stuck at that job you don't like. So you don't have to be stuck in the same routine paycheck to paycheck situation. Again, this is for the future you. Avoid the impulsive decisions that's going to hurt you. And then we still got to harp down on the good habits, compound on the good habits, right? So having a growth mindset, again, we got to be able to adapt to change. We got to be resilient and we got to embrace change, right? So again, stick to your investments, have conviction, but don't be stubborn. All right, don't be stubborn, please, because you may think you know everything, but trust me, you don't. And even me myself, I got proven wrong many times on certain things, and you live and you learn, but you have to come to that realization a lot quicker. Don't think, oh, you found the next best thing. You found the next whatever it is. The market doesn't see what's going on here. Blase, blase, whatever it is, right? Be open to change. Be open to adapting to what's going on. And portfolio structure really matters a great deal. You have your foundation built out as strong and as solid as possible. And then those off the wall ideas you may have or out of this world, investment you probably found. Take the risk with that, but with such a small allocation of your wealth and your money that if it does not pan out, you're not hurt in the end, right? So don't be stubborn to thinking that I'm gonna bet it all on this again, some random company in Idaho that no one knows about because I just know I'm gonna ride it out for 5, 10 years. It's gonna pan out. It's gonna pan out. No, build an extremely strong foundation. How we discussed before, across whether it's ETFs, index funds, the top 500 companies in the S&P 500. You have the VT or VTI or the VOO, whatever it is. Have a strong foundation built. Then you compare it with some satellite companies, that you see a future in. And then you have your moonshot category. You have your, you know, I'm just throw a dart at the wall and hope something pans out category. Make that like 5% of your portfolio, 1%. Something that if it pans out, great. You can sell it off, keep those profits, and roll them into your proven winners. That's stuff that you know is going to win. 10, 15 years from now, someone's guaranteed that the investment you have, S&P 500, top name, top quality company investment you have is going to be worth more than it is now. That's history has proven that, right? So, and again, that's with the foundation. I'm not saying, you know, Amazon's going to be a market leader 10, 20 years from now. We don't know that. It's a market leader now. I'm saying putting your bet on the top 500 companies, as in the S&P 500 being worth more than it is now 10 years from now. Yes, that's going to happen. The QQQ is going to be worth more than it is 10, 15 years from now. Yes, that's almost a guarantee, right? So that's what I mean by making those foundational bets, making those foundational decisions. And then on top of that, we're going to pair the company, individual companies who are the top in the QQQ, who are the top in the SB 500. Pick two, three out of those names, and then you allocate some money to those. But your foundation is still that S&P 500, that QQQ, or that, small cap, whatever it is that you believe in. That's still your foundation. That's still the base of everything. And then you have some pairings. And like I said, you have that random off the wall stock, random off the wall investment that you put some funds towards. Pans out, it doesn't. But that's what I mean with this whole growth mindset. Like, don't be so stubborn and stuck in the box that you think you know everything. Because trust me, you do not. And the market will show that and prove that to you. So then we go to the risk tolerance awareness. Something else you have to discover about yourself and know what type of investor you are. If you're someone that can't stomach seeing your account have 10K and go down 10% in a span of a week, 2 weeks, when it's just a simple, the market selling off situation, right? It's probably not for you. Again, when I say a simple market sell situation, is it's a market sell off. It's not you made the wrong investment choice. It's the overall market selling off. Everyone's having, their portfolio in the red. And then back into the risk tolerance thing, you don't want to put too much money on that random company in Idaho. That's where this comes into play. You have $1,000 portfolio, $10,000 portfolio. It's $1,000. $100 should probably just be, no, I mean, not $100. $10 should probably be on that random company that's in Idaho. Like, don't even pay attention to it. That's what I mean by risk tolerance. You have to put the majority of your funds, the majority of your hard-earned dollars towards the guaranteed winners, right? And then you have to figure it out for yourself what type of risk appetite you have as an investor. And then we got some strategic investing techniques. So value investing. So this is basically looking for underpriced stocks and underpriced equities that, the market may be missing, or something that you can see that's at a favorable deal for you. So on our website, thewealthcatchers.com, I have a whole section about breaking down a company, evaluating the company's stocks and financials, and then from looking at stuff from the quote page in terms of the PE ratio and things of that nature. So that's where you use your stock evaluation at, and also the long-term benefits of everything. So again, you're measuring these valuations to something like the S&P 500 or to industry peers or sector peers when you're making these decisions about whether I should buy this stock or whether is this a good investment, right? That's who you're gauging it against. You gauge it against to its competitors, likewise in the same industry, or against the S&P 500. S&P 500, for the most part, should be your benchmark for everything. It should be your evaluating a company to the S&P 500, and it also should be this company is outperforming the S&P 500 or has proven it can outperform the S&P 500 over the past 10, 15, 20 years, whatever it is. This is why I'm putting my dollars in it, right? Because that's the whole point of it all. Again, if you're not looking to beat the market, you just want to be on par with the market, you could save yourself so much trouble. Just buy the market. Just buy the S&P 500. You're guaranteed locked in your fair market share, right? But I'm someone that's on the other side of it. I'm someone on the, I believe, with my knowledge and with the knowledge that I could pass on to my family and my children, that we can beat the market, that we can surpass the market. And a lot of people do believe that and don't do it, right? They don't make it, and that's fine too. But I'm one of those ones, I'm willing to put my hat in the ring and try to do that just off of quality names, quality entries, buy and hold. That's what I'm doing. And so far, when I look at my son's portfolio, I am very pleased and very happy with the performance we've had, being at his young age and where we're projected to be at by the time he's 21 years old. I'm definitely proud of how everything's panning out. I'm proud of myself for making that decision. And again, the stock valuation played a big part in this. Timing, pricing, why this company, why this sector, why this industry. Again, do the knowledge, do the work, right? So that's another principle to follow right here. We gotta make sure we evaluate these stocks and these companies correctly. And then back to dollar cost averaging. So consistent contributions, and it's helping you mitigate risk where you're buying high, low, and in the middle, right? So my variation of this is I have a whole article that's on my website that's about how I'm investing for my child. And our way of doing it is we use holidays and events like birthdays, and we also use situations like a tax refund that you get your tax credit for your child. Those are our moments of quote unquote dollar cost averaging. So we get those lump sums of monies from whatever event it may be, and I have it put in the account, and then I go off of my evaluations of how I look at stuff, how I view it as a good time to buy, as a good time opportunity to build on this position for him, or as a good time to get into this for him. So that's how I value these things. So that's my quote unquote dollar cost averaging. You know, it's not directly it buying at no matter what price, but in terms of the times of the year money is being allocated to his account, they're pretty much always consistent in terms of when money's getting put in there, and also trying to be cognizant of keeping a certain amount of dollars on hand in cash to take advantage of opportunities for him. But DCA or dollar cost averaging is another good prime way to keep yourself ready, keep yourself in the market, and keep yourself active, right? And then more common pitfalls to avoid. We got the I know this is different from what I was saying because me, I am waiting for certain times, or I don't like to say times, but I am waiting for certain price points. I map them out, I mark them out. I'm someone that believes that you could get a better price, but this could be a pitfall for some people, as in market timing. And the reason why this is listed in here as a pitfall because it's depending on how you're viewing market timing. There's people who are market timing in terms of everyone around them saying everything's high, everything's overvalued, and they're like, "Oh, maybe it is. I don't know, man, bro. The market seems too high right now. Everything seems hot." They're not. Those are people who are just going off of what everyone else is saying instead of them actually sitting down, looking at the charts, reading the reports, again, doing the knowledge, right? So that's where it's different in terms of how you're doing your quote unquote market timing, right? If it's a quality name, quality investment, and it just happens to be undervalued, right? Something like Google, highly undervalued for a long period of time, and then it reached, stardom again. Because that was the whole AI revolution stuff. It was behind. It was coming up with stuff that wasn't making any sense. It seemed kind of behind. Someone like Apple never had a major AI announcement, and then people left it for dead. And all of a sudden, it broke a all-time high, maybe a month or 2 months ago, if I remember correctly. So it's those type of things where we see that yes, market timing is playing an effect into that, but you can be right in it if you understand what you're doing. But don't fall victim to just because he or she said the market's high or the market's low. This is why I'm not participating or why I'm participating. Create your own thesis. Come up with your think for yourself. That's what I'm gonna say. Think for yourself. Stop letting other people think for you and dictate what you do with your dollars. Be an adult and think for yourself and execute based on what you believe in and trust in, right? And then again, we have the hidden fees. I mentioned this before. No stacking the ETFs, no stacking the index funds. Pay attention to what you're putting your money into and what your the cost it is for it, right? So you definitely got to pay attention to that. And then again, hot tips. So and so said to buy this. So and so said the stock's running up. We're avoiding that at all costs. Always do your research before acting, because if it's a train to catch and everyone's on it, you most likely probably definitely missed it already. And you're gonna be left holding the bag. You're gonna be at the top of the mountain with all the luggage that you need to carry back down. You don't want that to be you. And then confirmation bias. So be aware of what information you're getting and where you're getting it from. I'm someone that you want to hear the bad too. Have the contrarian view of it. There's some people in the market too. I call them like bulls, right? You got Tom Lee, who's well known as a bull. You got Dan Ives, known as a bull, and then you got people like Michael Burry, known as a bear. You got people like Ray Dalio that could be bearish. Someone like even like Jamie Dimon could come off as bearish a lot, and they both can be right. That's the thing you have to understand. They both can be right, and you want to listen to both sides because both of them have valid cases. The bear and bull case, very valid, very compelling, and you have to take both sides of those information to make your decision. And then that's where you have to be aware of falling too much towards one bias because it's your investment. You want it to be right, you want it to work out, but you have to understand the pitfalls, that what can go wrong, and then stuff like the 10 Qs. They have a whole section, my bad, 10 Ks. They have a whole section in that annual report that tells you, hey, here's what could freaking go wrong. This is all the crap that could mess us up. And then they tell you black and white, like, yo, if this happens, this happens, this happens, we're done. Or it's gonna be bad news for us, right? So read those reports, dive into the. We have tools nowadays, right? You can do a SWOT analysis on a company using ChatGPT, Claude, Perplexity, whatever, Gemini. You can do the research on there. Hey, what can hurt Microsoft in the next 5 years, or what are some things with Microsoft that I'm not aware of that can hurt me as an investor that I should pay attention to, right? You could ask it to write you the prompt that you need to put into the prompt to get you the answer you need, right? So use these tools, right? And avoid herd mentality, resisting the urge to follow the crowd blindly, right? So we don't dive into any investment, dive into anything just because he or she said, without doing your own research, without you looking at the numbers, without you doing risk mitigation, without you doing the pros and the cons. Like do the work. Stop looking for a handout. Stop looking for someone to hand you something. You know, do the research. Do it yourself. Because again, this is to save yourself, your future you, your family, everything. This is tying your wealth to freedom, tying your hard-earned dollars that could buy you the freedom that you've been seeking for so long. That's basically what it is, right? So you have to stop waiting and hoping that something's going to come through and save you because it's not. And that's the hard honest truth. So we have to, you know, don't fall for the yes men. Don't fall for everyone agreeing with what you're saying is correct. Your investments are correct, this and that. No, you want to go in there and poke holes in your own thesis. You want to go in there and poke holes in your own investments. Why can't this work? Why won't this work? And then reinforce it with your confirmations that you've come up with your own self, things that you have done the work for and figured out, right? So overall, those are some principles, some guidelines to follow. This is one of my shorter and quicker videos. So I do appreciate y'all stopping by, listening. And again, emails right there, thewolfcatcher@yahoo.com. Reach out, send a note, send a message or anything you want to talk about. I'm all ears. I'm here to answer any questions. Go to the website, thewealthcaptures.com, read about some articles, check out the monthly watch list. Drops every month, usually every first of the month, about what happened in the previous month, what we're looking towards to in terms of the month that's coming up. And I got the price points in there for entry points for stocks that I've been following for. Some of them been following for about a year. Some of them been following since 2021. So definitely tap into there. And again, like, comment, subscribe. And in the bottom, should have some links down there towards the website. Have a link down there towards Robinhood. It's an affiliate link. You get a free share of stock when signing up with it. I get one as well to be fully transparent. And over time, I'll come up with some more links. I definitely want to dive into some life insurance stuff that I have a link with Ladder Life. I believe life insurance is a very important thing. A lot of us, don't take advantage of and don't have as a layer of protection on ourselves for our loved ones. So, but definitely keep an eye out for some links that I'll have in the bottom to certain products, whether it's books. Some of them will be affiliate, some of them won't be affiliate links. They'll just be links to information that I think is very important and things to take advantage of. But again, thank you guys for stopping by. Appreciate it. See y'all next time. Peace.